Welcome to On Investors' Minds. I'm Kerry Craig, Global Market Strategist at JP Morgan Asset Management. Thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building robust portfolios. Now, increasingly, we see the need for alternative assets and having a growing role within portfolios as we think about the need for income, appropriate levels of diversification, as well as alpha generation. Now, this can be challenging in public markets at times and why we're seeing more interest in alternatives overall. Each quarter, the Market Insights team actually produces our guide to the markets, but also a sister publication called the Guide to Alternatives. This compiles a vast amount of information across private markets that we then publish for easy use and easy access on our website. The fourth quarter edition of that Guide to Alternatives is actually available right now for you to download. Now, this week, to discuss that fourth quarter Guide to Alternatives, I'm very pleased to be joined by my colleague, Aaron Mulvihill. He is based out of New York and part of the Market Insights team, but he is also the driving force and spearheads the publication of the Guide to Alternatives every quarter. Aaron, a great pleasure to have you on the show. Thanks for joining us.
Thanks for having me on the podcast, Kerry.
Now, I want to start the conversation with a topic that is very much all-encompassing at the moment, and I'm sure a lot of questions in the US that you're getting from clients, and that is around artificial intelligence. Now, we're getting lots of questions around, given the high valuations, some of the volatility we've seen in the markets, but also obviously how there's this increase in investment in CapEx, the use of debt to fuel that CapEx in the future to meet the expected levels of demand. Now, overall, when we wrote about our 2026 outlook, we were thinking about how investors could play that secular theme of AI across the value chain in public markets, but also this naturally extends into thinking about how we see it in private markets as well. We're coming to thinking about, that demand that comes from electricity, the build out of data centers. I was wondering if you could talk us through us using, the data you see within the Guide to Alternatives about what we're seeing in terms of real assets and how that links back to AI.
Yeah, absolutely, Kerry. And we're excited to be launching the guide on December 8th. It should be coming out. And one of the big themes in either in public markets, but also in private markets is AI, artificial intelligence. When we put out our outlook for the US on the front page of this, we used an image of the Greek god or the Greek titan Apollo that has the world in his shoulders, and he's sort of struggling with the weight of this world, except instead of Apollo, we created, of course, an AI-generated image of a kind of cyborg robot that's holding this world that's got a lot of challenges in it right now. It's got high inflation and interest rate uncertainty. There's high valuations. And so a lot of questions we have around valuations, around the viability of returns in public markets. And we've seen, of course, in recent weeks, some jitters in public markets linked to the AI theme. I think for a long time, private markets, private equity in particular, has been looked at as an alpha generator and has certainly been successful at that. If we look at the last 20 years, for example, the median private equity fund returned about a 5 percentage point premium versus public equity. But increasingly, what we're seeing is investors are valuing private markets and private equity for their diversification benefits. I think there's options to lean into AI theme in private markets, but also to diversify away from AI in terms of public markets being highly concentrated right now in this theme. Even as a passive investor, you're holding 35% of the S&P 500 is in the Mag 7 stocks. And if you add in the AI-linked stocks in that index, that gets to an even higher number. Whereas you look at the private markets and private equity, a lot of investors are viewing this as a way to get exposure to a broader sector of the economy. Some of the smaller and mid-sized businesses that are more domestically focused, they're less technology driven, they're less impacted by geopolitical issues or supply chain issues, but continuing to see robust and very resilient growth. I think at the same time, there are opportunities to lean into AI, of course, within the private markets. If we look at the amount of spending that's being done right now by the hyperscalers, I think it's estimated at about $350 billion this year of CapEx will be spent by the major hyperscalers, you can view this as a transfer of value between or from the public markets to the private markets. Because if we look at the beneficiaries of this capex, part of it is GPUs, but a large part of it is constructing the data centers, building the energy grid, um, the venture capital and private equity owned companies that are building the technology to enable modern data centers and the AI linked components of them, as well as private equity and private credit that are increasingly financing the build out process. And we've seen, this year that this has been kind of a new trend for the last several years. A lot of the AI build out has been primarily cash financed. We've seen for the first time this year some of the major hyperscalers raising money in both the public markets through debt issuance, but also through private credit. So there's not opportunities to lean into this theme or diversify away from it. I think every investor is going to have their views on where they want to be positioned. One of the favorite charts I saw recently around AI was, I think it was in the Financial Times, and it was a chart that showed, well, within the next 5 years, AI is likely to lead to either human extinction, human kind of utopia, or an increase in GDP of 0.2%. So there's all kinds of probabilities out there around how AI is going to evolve. And investors have to make choices around how much they want to be exposed to this theme versus to diversify away from it based on what their investing goals are. And I think
But
one of
yeah,
the areas, oh, please.
a great example in the law of averages there. We're going to get a small pickup or either very diverse outcomes. Somewhat
Indeed.
similar when you try and figure out what the consensus is for thinking about the Fed funds rate in the future. It seems to be either someone thinks a lot of rate cuts or a lot of rate hikes, and you kind of dealt with something in the middle.
Infrastructure is maybe worth talking about because this is one of the areas where um, it can offer benefits to investors in terms of getting some exposure to the positives of the AI theme, but without some of the volatility that comes with that. And here I'm talking about core infrastructure allocations. Uh, and so an infrastructure fund that's invested in, for example, power generation and transmission, utility infrastructure. A long time, this has been viewed as a very sort of safe and stable investment, and it still is today. Um, but because it's providing power to homes and businesses, and that's a very sort of resilient demand driver. But we've got an additional source of demand now, which is the power generation needs of AI and data centers. But that's not that's not the be all and end all of investments like this. There's a kind of a base load power that's required to today in terms of powering home and businesses, but we have this incremental demand driver, which can be viewed as de-risking that investment or potentially making it a more growthier investment in time. So that's an area that's certainly been a beneficiary. I think whoever wins the AI race, whichever hyperscaler or AI model builder, there's a lot of debate around that, but I think there's broad consensus on the fact that we're going to need more electricity to power this need to power the data centers. That electricity has got to come from somewhere. The incumbent producers of this of energy today have a significant advantage. I just put out a blog a couple of weeks ago on nuclear, for example. There's been a lot of hype around nuclear and nuclear equities in the US, at least. But if you started you put the shovel in the ground today, you'll have a nuclear plant maybe 10 years from now, and there's a significant amount of regulatory risk. So we see right now a lot, sort of a bigger advantage in the incumbent producers of electricity that are producing through renewable sources, through gas, that are providing power to consumers and homes and businesses, but have the ability to participate in the AI ramp up and making long-term contracts with hyperscalers that have these additional power needs for their data centers. So that's been an interesting area that kind of allows access to AI theme, but with lower volatility from that investment.
Yeah, it certainly is the case when you think about this. These are long-term secular themes, they're long-term investments, and therefore they require long-term capital. And that's why you see them going to private markets to fund this. And I think when we look at the the public markets, and there's still this debate about whether it's sort of rational excitement or irrational exuberance, as one of our colleagues likes to call it. The size of the valuation in terms of the money that needs to be allocated towards this build out based on the demand numbers that are being forecast. I mean, that capital is going to come from everywhere. It's going to be
Mm.
investment grade credit. It's going to be public debt. It's going to be private debt. It's going to be private equity. So, I mean, there's room there across all those different asset classes for thinking about how to fund these projects. You kind of touched on private equity there in terms of thinking about some of the leaning into AI. It's not always about AI and private equity. I mean, what is just the general appeal for thinking about a private equity allocation for an investor? And then perhaps could you touch on, we've seen a bit of a pickup in IPOs and M&A activity. What's the expectation around that as we look into next year?
Yeah, yeah, certainly not all about AI. I mean, certainly the venture space is more tech heavy, but private equity, for a long time has been a way to get access to the broader economy. So, and that's particularly relevant today when investors are looking at the broad stock indices that are at a level of concentration that's really unprecedented, and they're maybe more concerned about this concentration and the concentration from the AI theme and looking to diversify away from that. So private equity has been attractive as an alpha generator. And I think it's going to continue to be attractive as an alpha generator in our long-term capital market assumptions that we produce every year. And this year actually celebrated the 30th anniversary of the long-term capital market assumptions, or what we call the LTCMAs. We put explicit return expectations per asset class, and that's the page that everybody always flicks through before they get to the commentary. They look to see what are our return expectations. And for in public equities, US large cap is 6.7% long-term return expectation through the business cycle, whereas private equity is 10.2%. So it's about 3.5% uplift. So that premium still exists, even though we get a lot of questions around a lot more capital coming into the space. We do expect the premium to persist. Some of that is a illiquidity premium, but I think a lot of the premium, or more of the premium, is really just the active management that's inherent in private equity. So there's no such thing as a purely passive allocation to a private market asset. And what private equity fund managers are doing is they're acquiring businesses with controlling stakes and the ability to improve these companies, and very actively managing and improving their revenue, reducing costs over time. So I think that's the premium that investors are paying for, is this active management. And going forward, the ability to add value to underlying companies is going to be increasingly critical, because we're in, and we'll get this in a moment, I'm sure, a more challenging time for fundraising. We're seeing more capital being concentrated in the larger fundraisers and the more established investors, because investors value more now the ability to generate alpha rather than pure beta exposure. And in terms of the capital markets activity, we have a slide on this in the Guide to Alternatives, where we look at M&A and IPO activity. It's been a challenging several years. I think going back to 2022, where we had interest rate hikes that kind of put the brakes on a lot of fundraising and M&A and IPO activity. But we're starting to see that turn around. So this year will be the third consecutive year of growth in both M&A and IPO volumes. Particularly strong year for M&A. And as we look into 2026, we're very optimistic about capital markets activity in general for next year, which should bode well for private equity. Number of factors come into this, and I would acknowledge that we talked about these factors coming into 2025 as well, but we got with the new presidential administration coming into the US, we were expecting a very pro-business environment, a pro-merger environment, which we got, but we also got a lot of uncertainty around tariffs and geopolitical challenges and trade disputes, certainly in the first half of the year, which slowed down some of that enthusiasm. We seem to be coming to a point where we've got the major trade and tariff issues resolved. They're certainly not going away, but we've got a better understanding of how they'll likely be resolved. And as we come into next year, we still have this very pro business, pro merger environment. We have interest rates coming down. So we have the cost of financing coming down, both in the public markets, but also private credit has been a source of financing that is continuing to see spreads even coming down in private credit. So financing is getting cheaper. That's always a tailwind for M&A activity. And then in terms of capital markets, IPO activity this year has been strong. We've had a number of very successful precedents of companies listing from the venture space. That gives a lot of confidence for companies to list next year. And high public market valuations is always a tailwind. Those windows are when they open up, they're often not open for a long time. So we think we'll probably start strong coming into 2026, provided we don't have a major bout of volatility or another geopolitical issue coming in the way. And that's likely to be a positive for private equity and venture capital next year.
Yeah, we're certainly seeing an improvement in the exit activity that's coming through. And again, those headwinds that you mentioned, higher rates, the volatility in the markets having abated somewhat over the last, I guess, 4 to 6 months. It's allowed for that to come
Mhm.
through. And obviously, lower rates helping anything that has, a leverage associated with it, such as, LBO. So fiscal support still there, monetary easing still there in the case of the US. I mean, we do have. Not a rosy outlook, but I'd say still a constructive outlook on risk assets heading into next year. And certainly don't think about a recession, which would be a big headwind to this coming through. And I think actually one of my more favorite charts from the guide to alternatives when it comes to the private equity is simply the one that showed you that companies are staying private longer. It was an average of 7 years. Now you're up to about 15 years for companies before they go public. A lot more of that value is being created while they're in private. And that's really what you want to get a hold of as thinking about that allocation in the private markets and investors. Now, while there's been that increase in the sort of exit activity across the public sphere in terms of people going into M&A and IPOing, obviously we've seen a big pickup in the secondary market activity in private equity. Again, there's a chart in the guide that sort of refers to the deal flow this year. If you annualize what we have so far, it's north of 200 billion. That's well above what we saw in 2024 for secondary market activity. Again, how are we thinking about the activity in the secondary market going forward, its role in a functioning private equity market overall, and where we'd be positioning?
Yeah, so secondary activity probably had its advent in some challenges we saw within private equity, where there was for a period of time, kind of post 2022, less liquidity in the market, P firms holding their portfolio companies for longer, challenging time to sell. And so investors needing liquidity have turned to the secondary market. But I think as the market has grown and, as you said, hitting probably 200 million or sorry, $200 billion of activity this year, it's been a helpful both liquidity provider, but also an asset class in itself. And so for private secondary or for private equity secondary investments, one of the major points of attraction for many investors is they get immediate diversification. So these are investments in funds that may be multiple years into their allocation cycle. So they're already invested. We get some ability to understand the performance of the underlying companies. You can see the cash flows. So there's a lot more kind of confidence around the underlying companies within these funds, as well as a broad diversification. And particularly now we're seeing secondaries funds and evergreen secondaries funds that are more accessible to investors. They're shorter J curves, so that's been a challenge in private equity investment for private wealth investors, particularly that don't have a willingness to lock up their money for 5 to 10 years. Secondaries investments tend to have a much shorter J curve, which is really attractive for those investors. But I think the diversification angle is particularly relevant right now and resonates with a lot of investors, particularly when there's concerns around risk in the market or softening economic environment. It helps to be allocated broadly across a range of private equity investments.
Yeah, and I think it's the case of as we look at the discounts you get on offer in the secondary market. I mean, those discounts to NAV have, I guess, diminished a little bit. They're still there on aggregate when we look at it. Obviously, it diverse by deal, and that does allow for better matching. So you just get sellers are getting a little bit of a haircut, but obviously if you're buyers, you're getting still that discount. That better matching allows for more activity to come through, and it makes it more viable overall in terms of how we think about private equity secondaries contributing to the market overall. I want to come back to something you mentioned earlier. You talked about the link between private equity and private credit. Private credit being obviously a key funding source when you think about private equity. So as we think about the private equity market potentially looking a bit better next year, obviously think about how that influences the outlook for private credit, which has been an exceptionally favorable asset class for many investors I speak to, as they've looked for yield and been looking for things that aren't basically public fixed income for some time. But the risk and the concerns that I'm hearing obviously more often are around that link between public and private equity. Is it, Peter just borrowing from Paul? It's more around, these high profile defaults we've seen, the fact that that asset class has grown very quickly, and some concerns around the underwriting standards. I mean, we're sort of saying it's not idiosyncratic risk, but, how much risk is there in this private credit side? And maybe what are some of the metrics that you're looking at when you're assessing that?
Yeah, great question. We're getting a lot of questions from clients about private credit recently, and we touched on this in the long-term capital market assumptions. And of all the asset classes where we put return outlooks, I believe only private credit has the return outlook has come down relative to last year's numbers. And what's driving that is a couple of things. One is it's floating rate debt. So as interest rates are expected to come down, there is some linkage there, and private credit rates will come down. But also we do expect an uptick in default rates, and that to translate into lower yield. We don't believe there's a systemic risk in the market. When I speak to our colleagues across the business, across asset management and the investment bank, they do a lot of work in the private credit as well as the leveraged loan space. They don't believe there's a systemic risk, but there is an issuer specific risk, and there are sectoral risks within the private credit market. So the yield that private credit has offered has been very attractive to investors. It's what's led it to be the number one asset class within the private wealth space in terms of capital allocated. The yields have been, they've ranged over time, but today we're looking at 150 to 200 basis points premium that private credit is offering versus a high yield or a public market equivalent. So that's been attractive, but I think investors also need to be conscious that with high yield comes the potential for higher risk, and the ability to manage that risk is critical. That comes down to the manager ability and skills and experience within the space. It's an area where a downside focus, just like in public market fixed income investing, it helps to have a downside focus and be thinking about what can go wrong within the space. And that's certainly what how a lot of our colleagues are spending their time, is what can go wrong. The auto sector certainly has had some challenges this year. We're seeing deterioration in consumer financial health. And so there are sectors within that space that are likely to have more of an impact from that. So it takes a very active approach to management to be successful in private credit investing. But that premium we do expect to persist over public credit, even with the default rates baked in. So this is a time where it's an asset class that certainly has a place in portfolios and has benefited many investors and will continue to do so. But it's a time to be particularly vigilant in looking at the downside risks in asset and manager selection when choosing private credit portfolios. Helpful in terms of the yield premium, but there is risk associated with it that requires an element of diligence.
Yeah, I think that's absolutely right. I mean, there's the couple of aspects there. Obviously, in the US, we're thinking about more of a K-shaped economic recovery. Some of the stress we've seen is obviously impacting lower socioeconomic groups in the US, and that can obviously play through given the defaults more in the levered loan space we did see. And then again, to your point, the spreads, you're getting some compensation over and above what you did in the levered loans or public market space. But those spreads haven't really widened out significantly that would suggest that there is any risk being built in there. And then finally, I would remind like the clients I speak to in the Australian landscape, the private credit market here is very different to maybe what we see in terms of the underlying assets or sector exposure within the US or within in Asia. And obviously that can also deviate when you come down to the specific fund level. So really understanding what you're getting is quite key when we are thinking about some of that build up and risk that's coming through. Finally, I
Indeed.
want to talk about hedge funds. I mean, if anyone's listened to this podcast recently, they would have heard Tai Hui, my boss, talking about our approach to 2026 and the word discipline being mentioned quite frequently. We're thinking about the potential for more volatility across both public and equities and public bonds as we think about some movements we've seen in the VIX more recently, as well as some of that interest rate sensitivity that's come through. Again, not a recession in our base case. We're still constructive on risk assets, but we are aware of building in greater diversification into a portfolio, not thinking solely about the risk to downside growth, but also risk to upside inflation, and maybe harnessing some of that volatility we may see. And that naturally leads us to thinking about the role of hedge funds, given their diversification benefit in the portfolios. So when it comes to hedge funds, Aaron, like what are the trends that we should be focused on there?
Yeah, so it's becoming a very interesting time for hedge funds. Our hedge fund colleagues talk about the end of the alpha winter, where for the last decade or so it's been very challenging for hedge funds to outperform because their business model essentially is making long and short bets, picking winners and losers, and as stock markets are performing very well. If all stocks are going up, it's hard to pick losers. Similarly, in the bond markets, we've had a lot of stability, but we're coming into a period right now where we're seeing increased stock dispersion, so more ability to pick winners and losers. We're certainly seeing a lot of interest rate volatility, both on the short end and even more recently on the long end, or sorry, on the long end, but more recently on the short end of the curve, where the likelihood of a December rate cut has shifted back and forth several times over the last several weeks. And these are opportunities for hedge funds to outperform and generate alpha. That's their bread and butter is playing in times of volatility, making active bets, whether that's kind of computer driven um, statistical arbitrage type situations, or it's humans within the funds making active bets on where they see interest rates move, where they see particular stocks move. So the alpha winter is coming to an end. It would seem this could be the start of a more profitable time for hedge funds. Um, but as an asset class, even over the last 10 years during that alpha winter period, they still delivered on that promise of diversification and low correlation to a 60/40 portfolio or a traditional portfolio. And that's where they really come into their own. I think that's the place of hedge funds in portfolios is a provider of diversification with extremely low and in some cases even zero correlation to traditional portfolios. So for those investors that are concerned about drawdowns, they're concerned about a 2022 type situation where stocks and bonds both declined. Hedge funds can perform very well in these types of scenarios in providing additional diversification to portfolios and protecting them on that downside while generating consistent returns in the good times.
Yeah, so a lot of different opportunities or strategies that could be applied from the hedge fund perspective to capture some of what we're seeing in the market at the moment, and definitely worth considering when we think about building out a wider asset allocation view. I mean, as you mentioned, cash rates are coming down, but still at a relatively high level to history. That provides a good starting base given the cash allocations that are in hedge funds. And then so importantly, we've had that sort of quite strong correlation within markets in terms of performance, which makes it very difficult for hedge funds, but that does appear to be changing as well. Aaron, fantastic insights. Thank you so much for your time today. And also like to say thank you for continuing with a great publication that is the Guide to Alternatives. We do value it every quarter, and I'm sure our clients do too. So again, thank you for joining the show.
Thanks for having me, Kerry. Great to be here.
And the Guide to Alternatives can be downloaded from our website along with our 2026 Outlook and some other applications around our views on alternatives, including within the On the Mind of Investors publications that Aaron mentioned. If you enjoyed this podcast, please share with your friends and colleagues, and of course, consider subscribing. If you have any topics that you would value in hearing, please reach out to your JP Morgan Asset Management client advisor. My name's Kerry Craig. Ty will be back in the next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.